S&P is down almost 5 points right now, off its lows at 1404. Yes, fears over the fiscal cliff taking center stage once again, driving stocks lower after last week's 3% surge. That big gain we saw Friday, 172 points. We lost about a third of that right now. So how can you protect your portfolio in the face of the fiscal cliff looming right now? Let's find out in today's Closing Bell Exchange. We have Chief Washington Correspondent John Harwood, Bill Spiropoulos from Core State's Capital Advisors, who has a review of the new Lincoln movie, Lee Munson from Portfolio Asset Management, and our senior economics reporter, Steve Leisman, plus Mary Thompson. So we're going to be here a while. Let's talk about this. John Harwood, let's start with you. Any signs of progress on the cliff on the hill?
Nothing tangible, Bill, but there is a different mood about these negotiations. We saw it at the initial meeting between the president and congressional leaders. We saw it over the weekend when some Republicans, again, repeated their openness to being willing to raise taxes, which is something that has violated Republican orthodoxy in recent years. Here's White House Press Secretary Jay Carney just a few minutes ago in reaction to those comments.
Some of the comments you mentioned are welcome, and they represent what we hope is a difference in tone and approach to these problems, and a recognition that a balanced approach to deficit reduction is the right approach. It's the one that's most beneficial for our economy.
Now, the president's trying to take advantage of that different tone. He talked to Speaker Boehner over the weekend by telephone. And today you've had two business leaders, John Engler of the Business Roundtable, Tom Donahue of the U.S. Chamber, in to meet with senior White House officials. They're trying to keep this going. But aides on Capitol Hill tell me no substantive progress in negotiations yet. They're just now getting back to work after Thanksgiving.
Hey, Bill Spiropoulos, how does that make you feel about the market? Does it feel like they've got more kumbaya going on in Washington, D.C.? And does that make you more willing to invest?
Well, I'll tell you what, I saw Spielberg's Lincoln over the weekend.
See, I told you.
And it was incredible because it reminded me how nothing has changed on Capitol Hill.
I agree with you 100%.
In 150 years.
Don't you get so tired of everybody saying, oh, Washington is a mess right now. It's never been this bad. It's always been this bad, and you see that in the movie.
Well, we had a civil war in the 1860s.
It was worse.
That was bad.
People say it's never been worse.
Well,
it was worse.
Guess what?
I think
Go ahead,
Go
ahead, Bill. Do you think they can pull this off?
The one thing it reminds us is that you shouldn't bet on anything. We should bet on volatility. We should bet on the doomers and gloomers and Y2K, and here we go again. And the whole name of the game of success is to have a repeatable process on how to deal with investing, whether it's in stocks, bonds, gold. It doesn't matter. Have a plan, have a strategy, have consistency. And it's going to be volatile in every single asset class, I think, right through the end of January.
Lee Munson, you say as an investor, ignore the fiscal cliff, right?
Oh, yeah, I'm like Bill. I mean, you have to have a process. I don't really care what, they're doing. Now, do I care about some of my clients that have a ton of deductions? There's a lot of talk about capping deductions. Sure, I am. But I'm not going to go out and start buying municipal bonds or changing my investment strategy. The only thing I think investors could possibly look at is when, we use risk budgeting and risk management techniques. And I think that going into next year, there is a sense, at least at my firm, that we're going to have to squeeze more out of every tactical move we can because of potential tax consequences. But I just think that makes you leaner and meaner. What investors need to think about, bottom line, if you're a company that struggled over the past couple of years with this anemic growth, 2013, while I'm optimistic, think there will be growth, it's not going to be significantly different. So whatever has been able to survive the last couple of years, I think that's what you should keep an eye on, or you have a value trap.
Mary Thompson, the weakness in the markets today, that connected in any way to what John's been reporting about the willingness to raise taxes?
I think coming into it, a lot of people were saying, listen, we were oversold or overbought going into the end of yesterday's session, so they were expecting some kind of pullback anyways today. Michelle, I would say that was a big part of it, and also some weakness, of course, in that there wasn't any progress or isn't any notable progress in the fiscal cliff. That's too contributing to it. But really, given the strength of last week's rally, some people said we had to take a little money off the table coming in today.
And slowly, this market is still coming off those lows. The Dow now down just 58 points at this hour. Steve Leisman, while we're on it, I mean, we talk about the recovery that is slowly underway here. What impact did Sandy, the superstorm that hit a few weeks ago here in the Northeast and along the eastern seaboard, what impact? You've got some new data suggesting that more of the impact that it had on the economy.
Well, it's interesting because you guys are talking about what could be a man-made disaster. This is a natural disaster. AIR Worldwide, one of the companies that gauges the insured losses. These are only insured, doesn't count government, has significantly increased its estimate to 16 to 22 billion from 7 to 15. That is just about double, a little bit lower on the upper range, but really just about double. They're citing much greater storm damage than originally estimated, and of course higher payouts on insured losses. Mayor Bloomberg just this afternoon also estimating that the losses for New York City alone, this is not insured, it's all losses, economic activity and government, at 20 billion alone. So this may be, remember initially it was estimated as a $50 billion event. Maybe it's more like 75 or 100. And Bill, just a warning to investors, there's a lot of data coming up this week that's affected by Sandy. If you take a look tomorrow, durable goods could have a Sandy effect in it. New home sales going on to Thursday. You have jobless claims, again, a Sandy effect in there. And the challenge right now for those who are playing this short term is to kind of disaggregate what was Sandy and what's the real trend of the economy. And then when you're done with that, if that's not hard enough, figure out what the fiscal cliff effect's going to be.
Yeah, Bill Spiropoulos, all of that feeds into exactly what you were saying, right? Expect a lot of volatility, and the Sandy effect's going to make it that much harder to decipher what's going on with the economic data.
Well, and the economic data is going to be skewed by Mother Nature, by politicians, by a lot of things, and you have to have a longer view. More than 4 months, more than 3 weeks.
So what's your view right now?
I think overall, cautious, okay, but you have to be invested. You can't sit on the sidelines at earning zero and think you're going to accomplish anything. The one-year treasury at 0.25% doesn't work for me. But there's lots of opportunities out there. And it gets back to focus, having a steady hand, ice in your veins, and knowing to buy. Volatility could be a good thing for an investor with a strong stomach and an iron will.
Yeah, but I mean, you don't have to. But I think, Bill, when you say words like cautious, I think sometimes, I mean, I agree with Bill with what he's saying, but I think that, using a word like cautious, I think overstates it. You have to go in here, you have to go on the offense and use these dips to start buying. So I don't think people need to necessarily be cautious. I think what they should be doing is aggressively trying to pick up equity when they can. And maybe that means, using the volatility as best you can. But I don't think we're going to get the volatility a lot of people are expecting. I don't think we're going to have these, some big 10% correction before the end of the year where it's going to be obvious to everybody. Now I can step in.
Ladies and gentlemen, thank you so much.